The Gap Report, Linde Quarter 2 2026. There's a version of Linde's July 31st call that reads as a clean win. Record sales, record EPS. A backlog that hit $8.1 billion after another large electronics contract was secured. That version is not wrong. It is just incomplete. The more interesting story is what management did with the commitments made in May, what strengthened, what softened, and what required more careful handling than the original framing suggested. One of those topics is large enough to dominate this report. A second barely appears. And a third, which management treated in May with near-optimistic detachment, returned in July carrying considerably more weight. This is a company with real structural momentum. It also has a problem it has not yet solved, and the language around that problem has shifted in ways worth tracking. Delivered. The electronics backlog commitment. In May, Matt White made a specific auditable claim. I'd fully expect us to have a higher backlog by end of year based on this, higher than the $7.1 billion, and could potentially have an 8 handle on it. He called the probability pretty high. The $7.1 billion backlog figure at the time made an 8 handle feel like a stretch achievable, but dependent on contracts that hadn't yet closed. By July, the backlog stood at $8.1 billion, already at the 8 handle mid-year, not year-end. Sanjeev Lamba extended the commitment in both directions. I expect our sale of gas backlog to finish the year with an 8 handle, even after the $1.3 billion in project startups expected in the second half. This is the rare instance of a management commitment that was not only delivered, but materially accelerated. The electronics narrative hardened in precisely the ways the May call anticipated. The language around pipeline health moved from confident but hedged, high degree of confidence in adding substantial new projects, to explicitly directional. Electronics is the fastest growing end market, expected to remain our largest backlog contributor. The geographic mix Lamba described bulk of projects from the U.S., with strong pipelines in Taiwan and Korea and some from China, closely mirrors the distribution White outlined in May when asked about the concentration of demand. The Taiwan joint venture addition is worth noting separately. 2 electronics wins there, approximately $800 million in investment, were not counted in the backlog figure because of the non-consolidation structure. In May, White mentioned Taiwan joint venture sales were excluded as a non-consolidated 50% joint venture. The July call applied the same accounting, but the scale of what's now off balance sheet grew meaningfully. The $8.1 billion number understates total electronics commitments. Reprioritized. The margin expansion story. In May, White committed to full-year margin expansion, not just improvement, but expansion probably at the upper end or even above our traditional range of 40 to 60 basis points. He was explicit. Operating margins of 30% were steady, management actions were working, and any puts and takes within quarters were secondary to the full-year direction. By July, the margin story had a hole in it. Operating margins declined 60 basis points year over year, or 30 basis points, when excluding cost pass-through. Lamba's opening remarks acknowledged this directly. We are not satisfied with our margin performance for this quarter. White noted that excluding Lincare, America's margins would have increased. That exclusion does the heavy lifting in every margin defense offered on the July call. The framing shifted. In May, the margin trajectory was presented as a full-year story, confident in the direction, with quarterly variability acceptable. By July, that confidence narrowed. Margins are expected to improve sequentially into quarter 3, a near-term, quarter-by-quarter promise rather than a year-end target. The word expansion, used in May in the context of the full year, did not appear in July's prepared remarks when discussing margin direction. Lamba said, I remain confident in our long-term margin expansion story, a phrase that positioned margin expansion as a long-term commitment rather than a 2026 deliverable. The movement of the margin story from a near-term quantified commitment, 40 to 60 basis points, upper end or above, to a long-term qualitative narrative is a meaningful framing shift. Whether it reflects genuine execution difficulty or appropriate conservatism given one bad quarter is not definitively answerable from the transcripts. But the language chose a different register: manufacturing and hard goods as leading indicators. In May, White described double-digit hard goods growth in the U.S. package business as a positive leading indicator for U.S. manufacturing recovery, alongside mid-single-digit package gas growth. He framed this as evidence that the cyclical upswing was developing, though he remained guarded. By July, the same data point appeared again. U.S. hard goods sales are up double-digit % from prior year, but it carried a new complication. The mixed dilution from hard goods was now cited as one of the reasons operating margins declined. Linde described it as a good sign of U.S. manufacturing recovery. White echoed that it could bode well for U.S. manufacturing recovery. The language is essentially identical to May. What changed is the cost attached to the signal. In May, hard goods growth was a clean positive. By July, it was a positive that came with margin drag. The analytical conclusion management drew remained the same. The financial consequence of being right about manufacturing recovery, margin dilution, was not mentioned in May and was treated as temporary and acceptable in July. De-emphasized or absent. The EMEA industrial recovery question. In May, EMEA was a topic of substantial discussion, the source of meaningful negative volumes, ongoing chemical and energy customer weakness, and a real question about whether any catalyst could shift the trajectory. White identified EMEA as one of 3 cylinders not firing, noted that a true global recovery required all 3 regions moving in the same direction, and gave detailed commentary on what might serve as a catalyst. The IAA reaching the ground, import restrictions, clarity on environmental policy. In the July prepared remarks, EMEA barely registers. The mention is brief. Aside from these regions, both end markets remain flattish across other geographies. In Q&A, there's a passing reference to Middle East-related challenges in Asia affecting EMEA indirectly. No analyst asked directly about EMEA's industrial trajectory, and management did not volunteer an update. Evaporated narrative. The detailed EMEA industrial outlook, the cylinder metaphor, the catalyst framework, the specific question of whether European chemical customers were bottoming, did not return in July. The topic moved from a substantive discussion point in May to a single line of qualified flatness. This may reflect that EMEA remains weak, and there is nothing new to say. It may also reflect a deliberate choice to center the July narrative on what's working: electronics, backlog, aerospace, commercial space, rather than revisit a region that hasn't improved. The engineering business timing drag. In May, White flagged approximately 1% EPS drag from the engineering business, specifically a timing issue between internal capitalized projects and external revenue-generating projects. He cited it as one of the items management needed to work through to get back to the 8 to 12% management actions range. The engineering business timing issue received no standalone mention in July's prepared remarks. It appeared briefly in the cash flow discussion. Higher earnings are partially offset by unfavorable timing in the engineering business, but without the forward-looking context White provided in May. The 1% drag was named as a problem to solve in May. By July, it seems to have been absorbed into the general operating narrative without update. The Woodside project. In May, White provided detailed updates on the Woodside project. Nitrogen startup expected mid-year. ATR and TNS slipped into Q1 of the following year due to Gulf Coast construction delays. He described it as a named project with a specific phased startup schedule. Woodside is not mentioned in the July call. Given that the nitrogen portion was supposed to have started up mid this year, the absence of any confirmation, positive or otherwise, is a gap. Either the startup occurred as expected and was absorbed into general backlog execution commentary, or it was folded into the broader project startup discussion, more than 20 projects representing $1.3 billion in investments. The July call does not say. A question that was answered in detail in May now receives no answer at all. Narrative positioning. The Lincare problem, from acknowledged headwind to strategic question. This is the dominant narrative of the July call, and it requires the most attention. In May, the U.S. home care business, Lincare, was introduced as a specific, bounded problem. White described it precisely. In late 2025, a new U.S. healthcare policy resulted in less services for a specific piece of equipment. He framed it as a headwind that will continue for the next several quarters, situated within an otherwise resilient healthcare portfolio. Aside from this particular issue, the rest of healthcare was performing as anticipated. The framing was, we have a contained, identified problem driven by a policy change, and we're managing it. By July, contained was no longer the operative word. Linde opened the call by flagging margin underperformance, and Lincare was the primary explanation. Operating margins declined, primarily driven by the Americas segment. The majority is driven by the U.S. home care business. The pruning actions management had been taking had simply not been enough to overcome the continued headwinds, led by higher cost inflation and policy changes. That final phrase, not been enough, is language that did not appear in May. Then came the sentence that fundamentally repositioned this topic. We continue to evaluate the strategic fit of this U.S. home care business within Linde, both in part and as a whole. This was not in May's prepared remarks. It was not implied. The May framing was improvement-oriented. New management team in place, pruning underway, policy headwinds manageable over the next several quarters. The July framing adds a parallel track, operational improvement and strategic evaluation of whether the business belongs in the portfolio at all. In Q&A, Jeff Zekauskas of J.P. Morgan pushed directly on this. White confirmed the Lincare headwind was approximately $40 million in quarter 2, 30% higher than Zekauskas' $30 million estimate, suggesting a rough $130 to $140 million annual run rate drag. Linde told Zekauskas, "We're also evaluating what the strategic options for this business are. I want to make sure that we do that exercise with diligence and determine one way or the other. This business is going to have a meaningful positive impact on our portfolio." Narrative inertia. The series of actions underway. Language appeared in both transcripts. In May, those actions were the story. In July, they remained the story, but management layered a strategic review on top of them, which implicitly acknowledges that the actions may not be sufficient. The positive language persisted. The implied confidence in the outcome did not. The dollar math that Zekauskas extracted is worth sitting with. $130 to $140 million in annual drag from a business that has faced persistent headwinds for years, has required a new management team, and is now being evaluated for partial or full divestiture. This is not a quarterly noise item. It is a structural drag that management, to its credit, finally named with precision on the July call. The Helium narrative. From positioned opportunity to managed constraint. In May, White described Helium with something close to strategic optimism. Linde was well-positioned despite the Strait of Hormuz disruptions, had excess molecules beyond contracted customers, was signing new long-term agreements, and expected pricing to continue to go up and roll its way through the year. The Helium situation was framed as a competitive advantage, Linde's broad sourcing base and cavern storage as differentiators, with incremental volume and price upside not included in guidance. By July, the same sourcing advantages appeared again. Linde praised his team's navigation of complex developments over the last many months. New customers had been signed with long-term contracts, but the recovery timeline changed. White said dollar contribution on Helium is positive, but not as large as we'd like. On margins, that grossing up effect right now is a little bit dilutive. More significantly, Linde told David Begleiter, "I don't think you will see normalization this year. Even after resolution of the Strait of Hormuz situation, normalization will probably take us into the early part of next year." Begleiter followed up, "Helium should be a tailwind next year. Is that fair?" Linde's response, "Helium will be normalized next year. I think we'll have to wait and see what that means." That answer is telling. In May, pricing improvement was anticipated throughout the year, incremental volume was being locked in, and any Helium upside would beat guidance. By July, the word tailwind is gently declined in favor of normalized, a framing that implies the business returns to baseline rather than providing lift. Whether management is managing expectations downward or genuinely reassessing the pace of Helium recovery is not clear from the transcripts. What is clear is the language moved. Q&A response quality. Laurent Favre, BNP Paribas, on Lincare margin drag and profitability. Favre asked directly whether the U.S. home care business was profitable at all and how large the margin drag had been over the past year. Linde provided the Americas ex-Lincare figure would have been up 20 basis points, but deflected the profitability question specifically. He confirmed actions were aggressively underway, but did not quantify the current profitability of the business. Indirect. Zukauskis later extracted the approximate dollar figure. Favre did not. Jeff Zukauskis, J.P. Morgan, on Lincare headwind size and divestiture decision. Zukauskis pushed on both the size of the drag and the timeline of the strategic decision. White confirmed the headwind was a little higher than Zukauskis' $30 million estimate, guiding toward approximately $40 million in quarter 2. On the divestiture question, Linde said the evaluation was underway and they wanted to do it with diligence, implying a multi-quarter process. He declined to set a timeline. Partially direct on size, indirect on decision timeline. Arun Vishwanathan, RBC Capital Markets, on margin recovery drivers. White answered this question in the context of comp dynamics from 2025 and identified cost actions specifically planned for quarter 3. He noted, "We will likely look to take some cost actions this quarter. Depending on the size, that's something we want to get ahead of." He deferred specifics to the October call. Constructive, but deliberately incomplete. The acknowledgement that cost actions are already underway, while offering no sizing or specifics, is an intentional withholding that the October call will be asked to resolve. Abigail Eberts, Wells Fargo, on the billion-dollar space opportunity. Linde confirmed the space sector was on track for that billion-dollar opportunity, with a 2030 timeline. Eberts asked for an update on the number. Linde restated the original number rather than providing new data. Direct but non-additive. The answer confirmed continuity of commitment without new information. The Gap Report. RNK Media. Not investment advice.